For those who are just beginning their Bitcoin journey, there's a lot of things that can appear scary. I think you and I are both used to it now because we've overcome that hurdle, but you have to kind of close your eyes and take a step back and remember what it was like when you first clicked that button to actually acquire Bitcoin and what it meant to memorize your private seed keys and things that are not natural muscle memories. I do share this belief at some level that Bitcoin is going to be the gateway for many people to enter the arena of crypto. And at the core, you spend enough time in it and you dibble dabble a little bit on MetaMask and push different buttons and get to experience DeFi, and all of them eventually come back to Bitcoin. And there's a really good reason for it. Bitcoin is the scarcest, hardest asset known to man, and it is the social covenant that I think will supersede the dollar as we've known it in a way that hopefully in the future will be synergistic for both American exceptionalism.
The financial world is entering a storm that has been building for decades. Money printing and rising debt have pushed the system to a fragile edge, and now the dollar's dominance is being tested in ways we have not seen before. For years, questions about stability circled quietly, but today, the noise is louder. Wall Street is no longer just watching Bitcoin. It is embracing it with open arms, and this summer has made that clear. Bitcoin is in the middle of a dramatic shift. While headlines celebrate new highs and booming interest, the truth is more complex. Beneath the excitement lies a dangerous question. Are we watching real sustainable growth, or is this just another house of cards ready to tumble when pressure hits? Institutions are not simply buying Bitcoin, they are building financial products around it, the kind that can create both power and chaos. This moment feels like history in motion, but history also carries risk. Crypto analyst Jeff Park explains what is happening and why it matters. He points to two major shifts that have already changed the market. First, the SEC approved Bitcoin ETFs to allow in-kind creations and redemptions, meaning Wall Street can now use real Bitcoin in a smoother and cheaper process to build ETF shares. Second, the option limits tied to Bitcoin ETFs were raised from 25,000 to 250,000 contracts, a massive leap that unlocks serious trading firepower. Both moves have cracked open the door for a new wave of structured products, giving Wall Street the tools to shape Bitcoin the same way it has shaped stocks and commodities. Park warns that this is a turning point, and Bitcoin is now playing on Wall Street's biggest stage. Now, let's watch clips from Jeff Park's explosive interview for more insight. Please don't forget to like, subscribe, and enable notifications for more in-depth content. Thanks for joining us again. Enjoy the rest of the video.
I always ask everyone to understand that financial history is very short. Most humans only live 70 years on average, in which like the cycle of money doesn't rotate very often. But if you study the history of money, it always resets. So that's kind of like a fundamental background assumption you have to have. And we really have to challenge what the monetary order looks like post-global financial crisis to now. And I think it's so crazy. It's now almost over 20 years. And yet the reason people keep referring back to 2008 was because that's when a lot of the social contract of the role of the dollar truly, truly broke. One amazing stat I will share with you is the balance sheet of the Federal Reserve back in 2008 was something close to $800-900 billion.
Yeah. And then it went to trillions, like...
Yeah. And so that's about 6% of GDP. And if you were to equate that growth linearly with our GDP growth as we've experienced for 20 years, that balance sheet should be roughly around $1.5 trillion. Today, it's not $1.5 trillion. It's $7 trillion, which means it's 20+% of our GDP. So already there, you can see something is awry. And so if you believe that like financial orders can change, that's the first thing. And then the second thing is like, why is it changing, and understand it, then the Bitcoin theory becomes so obvious. And so what happened from 2008 and on, the Federal Reserve adopted what we now commonly call as an ample reserve system or an ample reserve regime, which is really at the core challenging the role of interest rates, right? Because back then, before the ample reserve construct, the way that banks would pledge their paper to the Fed to earn a rate was really determined by the market itself. And And so the bank reserves were priced accordingly to what was available by demand and supply. And so the Fed really would have to control that market dynamic to set the interest rate policy that they want. But post 2008, what has happened really, and actually has been doubled down upon since 2019, is they are essentially fixing the rate by decree. And they will provide ample reserves that banks can put indefinite money across here to the liability stack and push out that rate, which means this rate is no longer determined by the market. It is literally determined by a human, by decree. And when you introduce those kinds of artificial technocratic manipulation, you can do a lot of things. So it really isn't an accident that the reserves grew. It just got untethered and unanchored to what markets should be rationally pricing. And so, well, how do you fight back? You have to fight back abundant liquidity. And the opposite side of abundant liquidity is scarce liquidity. And the only way to have scarce liquidity is to actually have collateral and commodities that cannot be printed out of thin air. You know this very well. We all believe this is why the Bitcoin thesis is so profound. And then I think you have to then give yourself the chance to imagine why it's important. For the latest, I've definitely been following what's been happening in DC in the construct of the Genius Act, the Clarity Act, all the AML KYC requirements around those constructs of crypto going mainstream. I think it's a huge moment. And we are now seeing the floodgate having opened where a bunch of stablecoin related news are coming out. I think it was yesterday that Interactive Brokers announced that they're going to have their own stablecoin. This is in addition to a slew of not just financial services, but even consumer-facing companies like the Walmarts and Amazon of the world who are exploring the utility of stablecoin as a payment mechanism. I think that is going to be a multi-generational opportunity to come. So that's really exciting. But in our domain and our lane of crypto equities, there's also been a lot of interesting things going on with the ETFs as well. So very recently, for the first time, the SEC has allowed the ability for APs to permit in-kind redeems and creations, which has always been a stickler point from the very beginning of the Bitcoin ETF journey since 2013. And in the event of the ETFs having launched, one of the concessions that was made was that only cash creates and redeems were permissible. And now we actually have the ability to natively contribute Bitcoin into the creation and redemption of these ETFs via the APs, which is an incredible win for the end consumer because it ultimately lowers the cost of trading, lowers the friction, and lowers the count of intermediation that necessitates the production of these ETFs. BlackRock has filed with NASDAQ and the SEC for a long time now, or almost a year, for which the open interest limit on Bitcoin ETF options were constrained at 25,000 lots upon its admission. And 25,000 is not a lot. And actually, if I recall correctly, even in the first week of those ETFs trading, they hit the position limits. In a way, there were some advantages to having that to give fairness to other ETF issuers. So for example, if I wanted to put on a position with IBIT, BlackRock's Bitcoin ETF, but the position limit was hit, maybe you would choose Fidelity or the Bitwise ETF or others where their option chain does exist for those as well. And there is a vibrant ecosystem of arbitrage that is possible between option chains across the same underlying holding, which is Bitcoin. But it's also a source of friction for investors who want to come in with big size. And so for a while, Deribit, I think, had maintained a pretty steady hold in being the predominant source of liquidity for crypto options. And over time, IBIT has made a serious dent in capturing a big chunk of that market share, both in open interest and across trading volume. And now what has happened is because the SEC has allowed the limit to go from 25,000 to 10 times that, which is 250,000, you can expect there to be a big gain of trading volume and notional interest that is coming mainstream to Wall Street, which is a big deal. The other part that was less public, but embedded within the same language, was they approved flex options as well for Bitcoin ETFs, which historically did not exist. So these things are important. And I've always believed that the structured products business is ultimately going to be one of the biggest businesses for Wall Street, because that whole business is about monetizing volatility and giving different investors a chance to have different risk preference. And this permits that tooling now in a way that hasn't been done before. I think over time, what we'll see is that the general range of Bitcoin's volatility is probably going to be more constrained, meaning that the fat tail events are probably less likely day to day. At the same time, I don't think it means that they'll go away. which is the reality that volatility can be measured in a lot of different ways. On one hand, the most classical definition is measuring the standard deviation over a 30-day rolling period, which shows you what a normal distribution of a stock movement could look like. But volatility can also mean something beyond that to a second order effect of like a jump risk. So, having a volatile stock for the sake of daily volatility is different than something that's not volatile for a while and then one day moves 100%. That would also be called volatile.
Jeff Park believes this is only the beginning, and his confidence is rooted in numbers and mechanics, not empty hype. He sees the market aligning from the top down and the bottom up. On the larger scale, he points to expected interest rate cuts, which always push investors toward riskier assets. Bitcoin sits at the center of that trend, ready to attract fresh demand. But what excites Park more is what he calls bottom-up strength. He reveals that more than $90 billion has already been allocated toward Bitcoin and crypto investment this year, and shockingly, half of that came in just June. These funds are controlled by treasury groups and companies whose job is simple. They must buy Bitcoin, no matter the price. This kind of capital is not driven by fear or hesitation. It is driven by mandate. That is why Park says Bitcoin is entering a stage of price inelastic demand, where buyers keep coming regardless of market swings. He also tackles fears around paper Bitcoin, where critics warn of artificial supply through financial products. For Park, this clash between skeptics and believers is a strength because tension creates explosive moves when markets break in one direction. In his view, the real innovation will come from companies that generate real profits and channel that money back into Bitcoin, turning conviction into sustainable growth. Let's watch more clips from the interview.
Bitcoin is really simple to understand. At sometimes people, I think overcomplicate these things, but really assets move because there's a market and people buy it and people sell it and there's more demand and less supply. And we're entering into the period in which that trend is likely to be accentuated. There's really two reasons for it. One is the top-down global macro perspective, which everyone is expecting the rate cutting cycle to begin. And from bottoms-up perspective, we have now seen tremendous capital raised for the purchase of Bitcoin by these institutional crypto asset treasury companies. And so I think Architect Partners recently put out something close to $90 billion has been put to work in Bitcoin and crypto assets since the beginning of this year. And in June alone, which is a month and a half, it's about half of that money that having been now earmarked for the purchase of Bitcoins once the merger consummations are approved for them to go live. And so there's a wall of money just waiting on the sideline. And guess what? These treasury companies are your most price inelastic buyer because their mandate is to go buy Bitcoin at whatever price. And when you see the overlapping forces of indiscriminate price buying and supply generally being constrained, and then on top of that, there's this dynamic where certain investors are playing this opportunity from a special sits perspective where they're short Bitcoin as a boxed relative value trade. That creates a really interesting dynamic where you have the chance to imagine a short squeeze while these Bitcoin treasury companies are unleashing the energy to come to market. So I'm very bullish, both from the macro and from the bottoms up of what's going on in the Bitcoin ecosystem. I think that there's a difference between an executive order mandate to buy Bitcoin as a strategic asset versus a congressional mandate. And what we're seeing is the ability to have a conversation around the more important aspect of the congressional mandate by having opened the path by Trump's adoption of the executive order. But the truth is, executive orders are fallible. They can be turned by the next administration if the political views don't align, and they're not stable because you don't have the embedded mandate of the people. So I think the real use case will be that we first need to get a legislatively approved strategic reserve, which I think we're quite far from. And we know Senator Loomis has been a driving force for it, and she is working very hard to build coalition around it. But I think until that happens, the idea of an executive order strategic Bitcoin reserve purchasing Bitcoin is maybe not the most useful kind of permanent capital vehicle that we can imagine. And so if you are coming from that perspective, it's probably not like the most important sign to think about the totality of what the US is doing with the dollar hegemony at risk. So, my view is It will be inevitable that governments will buy Bitcoin on their balance sheet. This is something I feel very strongly, but I do also think we have to be patient about it, where it is not likely a rogue decision. So the view that I've shared in the past with others is because the US is one of many in its global alliance across the trading partnerships and the economic order, there is a social contract in which how we trade with countries like Japan, where the dollar serves as a role for the transfer of goods and capital. In an ideal fashion, if you were to adopt Bitcoin as part of your treasury asset, it will make sense to me that you do it with some global coordination with your allies, because it would be a slight betrayal of that social contract if you were to stuff, let's say, Japan with all your long-dated treasury bonds and then didn't give them a heads up and just bought Bitcoin on your own, where the very kind of crisis confidence that would otherwise arise is one where they're not being attuned to. So the signs that I think I would wait for to see when a real strategic Bitcoin reserve adoption would happen would be some kinds of global partnership dialogues that are emerging. For those who are just beginning their Bitcoin journey, there's a lot of things that can appear scary. I think you and I are both used to it now because we've overcome that hurdle, but you have to kind of close your eyes and take a step back and remember what it was like when you first clicked that button to actually acquire Bitcoin and what it meant to memorize your private seed keys and things that are not natural muscle memories. And the fundamental principle of Bitcoin at the core is non-custodial self-sovereignty, right? In theory, that sounds great. In theory, the idea of the sovereign individual is the most powerful thing that you could ever hope for. But the truth is, most people actually don't want that much power either, right? And to give you a simple example, why do we generally try to use credit cards when we buy goods than your debit cards and just pay off the credit card anyway? It's because you kind of like the protection you get, where if there was kind of a merchant related issue or fraud, you can call them up and say, hey, unwind that transaction. That was bad. Give me my money back. And that's great. You can't do that with debit, right? I mean, that's why credit gives you that one more layer of protection. And Bitcoin can feel like that at times, where these natures of irreversible transactions can feel like that very thing that's empowering is the very thing that can cause a loss to you. So you do kind of want like some institutional stewardship of your money, where you have somebody call, or you can have somebody to complain, or you can have somebody that will support you and provide guidance and feedback. I think it's one of the reasons why Bitwise has been able to be a pillar for the crypto industry. It's not because people are not believing of Bitcoin. They really like the ability to call someone at Bitwise, talk to them about it, but also know the ETF is a very safe, protected, regulated, compliant vehicle that shows up in their brokerage account, and you can look at it and naturalize it with other things that you're comfortable with and kind of, sneak in there.
When Park looks at the bigger horizon, he sees a future where even governments will have no choice but to hold Bitcoin. The idea sounds radical today, but so did the thought of corporations placing Bitcoin on their balance sheets only a few years ago. Park explains that such a move will not come from quick executive action, but rather through Congress, because only then will it have lasting power. He also stresses that this kind of decision would require global coordination, particularly with allies like Japan, to avoid financial chaos and maintain trust in the world economy. Still, for everyday people watching from the sidelines, the hesitation is real. Bitcoin is intimidating, and its system of irreversible transactions feels unforgiving to anyone used to the protections of banks. Park understands that, which is why he argues institutional products are vital. ETFs give people a safe bridge into Bitcoin, one that looks familiar and removes the fear of handling it alone. He admits his own journey started in doubt. The 2008 financial crisis revealed to him the fragility of traditional finance, and it was then that Bitcoin's case as a scarce, decentralized alternative became undeniable. Park's message carries both warning and hope. He says the foundation for Bitcoin has never been stronger, yet he also knows the path forward is volatile. A global system based on liquidity and endless credit will not give up its dominance quietly. That is why he sees Bitcoin as the ultimate hedge. It is not just an investment, it is protection against the system itself. This summer marked a new era where rules shifted. Institutions armed themselves with powerful new tools, and billions of dollars of capital were prepared to flow in. The consequences will not be small. Hyper-financialization is now on the table, where Bitcoin stops being only an outsider's bet and becomes a structured, institutionalized asset. For Park, that is the true turning point. Bitcoin is no longer standing outside the gates. It has entered Wall Street's main hall. The question is no longer if Bitcoin will grow, but how much of that growth will be real, and how much will be built on fragile structures. For those watching closely, the chance of a lifetime might be opening, but it comes with the highest stakes we have ever seen in this market. Thanks for watching, and don't forget to like and subscribe.